and welcome to the Investing Master Series. My name is James Boyd. We welcome you on this Tuesday, March 20th, March 24th. We also have Barbara Armstrong with us in the chat. We welcome her as well. We got many of you asking questions, so we'll go ahead and hop right in as soon as we can. We'd like to welcome Scott. Give me the update. I'm coming to Hawaii there in 2 months for my son's wedding. Is it dried out, or should I bring a boat? Oh my gosh, it's been amazing watching that on YouTube. So give me the update, Scott. Now, also Josh, hello. Dean, hello. JV Texan, hello. Welcome to all. We got Barbara Armstrong again with us in the chat. You'll see her initials as BA. So if you have a question and you see her respond, you know that's Barbara Armstrong, who teaches later this afternoon on technical analysis. Let's go ahead and hop right in. Now, remember, Barbara and myself, we do post educational content on X. There's my handle. Barbara will post hers in the chat. That way you can just click on it and follow her as well. Make sure you do that because there's some great posts that we post throughout the day and week. Also, remember, when we talk about examples, we will talk about stocks. We will also talk about options. Remember that options, all the strategies are not the same. Some strategies you might consider, others not so much. There's reasons to consider different strategies. Understand that those options are not suitable for all investors. When we talk about the information here, it's provided for general informational purposes only. Schwab does not recommend the use of technical analysis as a sole means of research. Just example given, when we talk about some of the geopolitics, we talk about, let's say, macro, we talk about, say, intermarket analysis, fundamental analysis. There are other things that absolutely can affect technical analysis, as we have seen since the start of what's happened abroad. Now, by the way, that's exciting, okay? Technical analysis is very interesting, but it's not everything, okay? And it hurts me to say that, but it's so true. Now, remember, our examples will be done in the paid money software application. Investing involves risk, including loss of principal. And also when we talk about, let's say, short options, as many of you mentioned in the chat, short options like cash secured puts, those can be assigned at any time up to expiration, regardless of the in-the-money amount. That means you're the buyer. If you did like a cover call, they could take the shares prior to expiration. So we're talking about American-style options, okay, where that can happen prior to expiration. Now, also remember when we talk about our examples, we'll talk about the markets real quick. We've been talking about the kind of the four majors, okay? We'll take a quick look at those. We'll also talk about kind of some of the reversal that we saw yesterday a little bit. Let's talk about, is it actually starting to hold, or what names are maybe starting to get a little bit of a push? We will also follow through on some of the energy names. We will bring up some of the software that's under pressure. So our examples are going to be bullish and bearish in nature. Why? Because not everything in the market is bullish. And so there are some names that are still under pressure. Now, as we talk about bearish examples, I'm going to be very mindful of kind of the pace I take, because maybe in school you didn't have a class on how to trade bearish, okay? So I want to keep that in mind and also kind of give us some practice points there as well. So let's go ahead and so just know that we're going to have bullish and bearish examples. Let's take a look at just real quick the major four, okay? So when I talk about this major four, I want to slide this over just real quick. Yeah, there. Now, the major four that we've been talking about, okay? And if you might be thinking, well, my whole world is stocks. The problem is that might be your world, but that's not other investors' worlds. So when we talk about the major four, we're talking about oil. Now, the ticker that we've been using, which we could use maybe a couple of them, we could actually use, let's say, BZ, okay, Brent oil, okay. We could also, let's say, if we wanted to, we could actually type in CL. Okay, Brent would actually be kind of more worldwide, and then CL, light, sweet crude. Obviously, we'll look at that in just a sec. We're going to also look at the VIX. Can anyone tell me the last time the VIX was literally below 20? It's been a while. We're also going to look at, let's say, just a quick recap on the US dollar. And I think probably the biggest damage that we actually saw here today, again, was really rates. And I should move those over here. Now, when you kind of look at the volatility, the US dollar, vol, okay, US dollar, and rates, we might be thinking, well, what does that have to do with anything that I normally look at? The answer is everything, okay? Now, let's kind of start just real quick with just where oil is, okay? And that's going to affect maybe the energy sector, obviously. If we pull this up and say, what do we got going on today? We pull that up. What do we got? Now, I'll just pull up example given, BZ, Brent oil. Now, the biggest thing is yesterday when that tweet came out regarding they're having talks with so-and-so, I asked the question, was that even true? Okay. I mean, don't know. Okay. The biggest thing is big bearish engulfing on that. Today, little bounce back, not actually getting up higher than midsection of yesterday, but on the south side of the moving averages. Now, remember, if you're an equity investor, you like to see that. Okay. Now, obviously, as this chart has gone up. Now, by the way, when did this Iran thing kind of break out? Well, it really was right there. Okay. So, by the way, you should kind of remember this, maybe even kind of bring out a little writing pad or something you write down on. I mean, you kind of have something geopolitical and oil just took off. Remember that. Now, obviously, with that sector, how it plays into, let's say, stocks, sectors in general. Now, remember, we say some things like, well, too high, too high, too high, can't go any higher. Well, someone tell it to stop going up. Now, remember, when we talk about energy sector, people always forget, well, I totally forgot that you could just buy the sector or consider it. Or second, you might say Chevron, Exxon, ConocoPhillips, some of those names, FANG, okay? Some of those names that are in that space wouldn't have to dig very far. Just go down to your State Street or Main Street and look at the local gas stations for crying out loud. Those names actually today, brand new high, XOM, brand new high. What about FANG and brand new high, and ConocoPhillips, brand new high. So if you've been playing kind of some of those names, you've been kind of playing on this long, this thing overseas still happening, and people are still trying to get in that area. Now, and that trend has actually still been grinding. Now, the biggest thing is I want to kind of bring up here is when we talk about, let's say, the VIX, and this is going to kind of play into the strategy, okay? Now, remember, when the VIX is higher, that means choppier price conditions, okay? More swings. 1 minute you could be up, next minute you could be down. If someone's going to buy stocks in that condition, as we've said over and over again, the investor is probably going to be doing dollar cost averaging. Why? Well, because sometimes we don't think we're always getting at the perfect bottom. And the biggest actually thing is here, people try to build positions. And I don't know about you, but I'm wrong sometimes. Had to have some counseling to get to that point, but I'm wrong sometimes. Okay, joking, of course. Now, here's the deal. So with that VIX actually sitting here at 26, elevated, right? That means the S&P probably moves about 1.5% daily, and it has, okay? And if we look at the US dollar, you're going to notice that actually that is not necessarily going up right now, below both moving averages. Other currencies trying to get the push, but also notice that when did that break out to the upside? This right there was the date that geopolitical stuff happened. And you saw that some people moved back into cash. Remember that. And the last but not least, how we're kind of seeing something else play out that has been, for stock investors, a little hurtful. We see the rates going up, okay? Now, when did this start to happen? Well, there's literally, now remember, write this down. Don't just sit here and listen, okay? So what's interesting is when we saw this start to occur, the rates were at the low. And actually, as this actually happened, they're thinking inflation is going to go up, persistent cost. Borrowing costs of governments are going to go up. And you've seen the rate here. This is 39.5, but it's really 3.95, okay? 4.0 on the 10-year maturity. And these rates have actually gone up. Now, of course, how does this relate to us? Well, clearly, we could just go back to like, well, what about home building? Or what about, let's say, real estate in general? Well, if I pulled up, let's say, real estate in general, $IXRE, you're going to notice that, where was the top of this? Well, the top of this was literally right there, okay? So as we saw those rates go up, the opposite. Now, I'm telling you, please understand that the investor is trying to learn correlation. And so when we go back to this just real quick, you should be thinking to yourself, if oil up, then what? Okay? If oil down, then what? What are those relationships? We just kind of walk through that. If oil up, someone might go look at, let's say, the sector of energy. They might go look at the industry group of energy, the oil stocks. If oil, let's say, up, you can even say with that, maybe bearish airlines. If oil down, then what? Then they might be long airlines. Now, speaking of that, just real quick, let's take a quick look at where those airlines are. We talked about that yesterday afternoon. Oh, what do we notice here? Now, some people might be thinking that maybe oil might be a little high. And this is like a balloon at a birthday party, where they might try to take a pen and pop the balloon, okay? And they might be saying, well, option number one is go bearish oil the price. And then, for example, the second option might be like, well, I'm maybe going to go something that has an inverse correlation. That's the word of the day, by the way, correlation. An inverse correlation to maybe what that oil price is doing. Now, airlines, and we mentioned two of them, Delta, UAL, those are kind of some names that might benefit if that price comes down a little bit. I'm not saying it's probably going to go down to where it was, but if it just comes in some or down some. Now, I don't have anything to say on that, but I would just kind of we already have those positions. We did those yesterday afternoon. You look at UAL, that's lagged so far here today. I just want to also look and see, is Love getting a push? No. What about Alaska Airlines? No. So it's really those two that are still standing out. Delta being the strongest. I don't know where to go with that, but sure. Now, let's also, for example, bring up one more thing that we followed through on yesterday. I'll bring it up again. It's hard to not bring it up because it poked to a brand new high here today. Okay, calm down. Now, the biggest actually thing is what is going on with Dell? What is going on with Dell? Now, here it is. It hurts me to say this. Apple recently near some 3-month lows and Dell at some new highs. Okay, some of us Mac people just don't like that. Now, if you take a look at Dell, let's start here, okay? Now, you got to ask yourself the question, what strategies do you like to go at, okay? What do you feel comfortable with? Now, I want to kind of write down here bullish strategies, okay? Now, when we talk about bullish strategies, sorry for the spelling, you got to ask yourself, okay, we know way out here is stock, okay? And you got to ask yourself, what strategies are you comfortable with? Now, if you ask me that question, long call vertical, short put vertical, right? If we ask another question, like what else? Cash secured put, yeah, sure. Covered call, okay? I'm going to also put out here long synthetic. Now, we said before that if we're in a situation where the implied volatility is higher, okay, on this scale. So this scale is, think of this as delta. Higher the delta, you actually are saying, look, I'm going to pick a strategy that has a higher delta. And if you pick a higher delta strategy, you think you're going to nail the trend. You think you're going to be right. Now, the other side of this is if I said, well, what happens in this case if I said, look, the IV is high? Well, if that IV is high, okay, someone actually might say, look, I'm going to try to do positions where they're like long call verticals, short put verticals, cash secured put. Now, when there's a pro, there's a con, okay? Well, the problem with actually trying to use the volatility is wonder if the volatility goes up higher. Now, I want to talk to that just real quick in our first example. So if someone says, hey, if the IV is higher, okay, and you pick a stock position and you get the direction wrong, I don't need to talk about that. It can be a painful situation. The long call vertical, short put vertical, cash secured put can be a little bit more forgiving, but it doesn't mean that it doesn't hurt. It just doesn't hurt as bad as owning a stock position, okay? Now, let's bring this up just real quick. Let's go to Dell. Let's go to the trade tab for just a moment. Let's look at our first trade example. Now, when we look at Dell, we're going to go to actually the trade tab. Now, we're making an assumption, okay, but we have to verify with our own eyes. So if we said, hey, when we're trying to do, let's say, options, let's say we want to go out 20 days at the minimum. 20 days. Why? Because we want some time for it to trade. Why? Well, because I don't want to be the last one in, okay? I want to know there's other people buying and selling, causing that liquidity to be better. Liquidity, we're talking about the bid-ask spread and the open interest, etc. Now, if we look at this, where do we see liquidity? Now, we're not dead set on April. We'll open up May's and we'll hold it there. Now, if we take a look at this one only has 72 contracts, not a lot. This one right here has 600. This one right here has 1,200. Now, we have been in a situation where when the volatility is higher, they widen out those spreads. And this is where volatility can change, causing spreads to change. So in a market that's more volatile, it's tougher to get in and out at fairer prices, if you will, because they're trying to slow down the market and also try to de-risk themselves. Now, if we decided, hey, we want to sell let's say the 165, and I'm going to ask you a question here. If we sell the 165, that's the obligation to buy the shares at the strike from now to expiration. We get the premium, okay, and that's going to give us the break even. How many of you would do the 165 versus how many of you would actually do the 160? Now, if you said to me, well, James, I would like to kind of take a strike that is a little bit more forgiving, meaning the stock could go down more and still have a greater chance to be right. Now, the one thing to kind of remember here is when we say this is, if we sell the 160, now which one would you sell, the 165 or the 160? If we sell the 160 and we try to sell it at 445, and remember, the 160, they're telling us statistically right now, okay, there's a 28% chance to be below the strike. Now, that's not break even. That's just below the strike. If we said, well, the break even is at 155. Now, we don't have a 155.55 strike, but we do have a 155. And if we go down to 155 and say, what's the chances of it being right now below the break even? Okay. And if we kind of said in this case, so we have a 28% chance to be below 160. We actually have a 22% chance to be below the break-even area price level. Now remember, we don't have a 155.55 strike. So we're just eyeballing that and saying there's about a 22% chance it could be lower than the break-even as of right now. So you always got to understand, you are when we talk about investing, it's math, psychology, okay? And so when we look at this right here, if we said, hey, we're going to do that trade, they got about 78% chance to be above break even right now, and a 22% chance this could go south and it could get ugly. Now, when we talk about this, I want to bring up this Theo price for just a moment. We're going to go to option theoreticals and Greeks. We're going to go right down to where it says Theo price right there. Now, if we pull this up, I'm going to kind of play a little scenario. Let's say, example given, that in a week, March 31st, 1 week from now, let's say the volatility goes up 5%. Now, remember, we're assuming that we sell the put now. Let's say we sold it right now. But then as we're holding that position, the volatility goes up. Well, if the volatility goes up, what you're now going to notice is if we actually add 5% to the volatility from where it is now, well, when we look at the Theo price, you're going to see in this case that maybe we did not make as much as we thought. So if I take this out for just a second, this is very important you understand this. If we just said, let's say March 31st, but the vol stays the same, these options go from 305 to 217. We chose this strike, 355 to 265. That's great. But to get the time decay to come off, we need the volatility to stay flat. So we got to get so time is the only constant. But what's really helpful is getting the volatility to go down. Okay, so as a bullish investor, you don't want volatility expanding. You want volatility contracting. If the volatility is contracting, which I mean going down, that could actually be helpful. Now let's add this 5% to see the difference, okay? When we had that 5%, notice that it's not down as much as it was before. It was 212, now it's 262. Well, where'd the time decay go? It got offset by the volatility increasing. This is why we've said over and over again, if you're in a situation of you have cash secured puts, some investors say, look, I'm probably going to have 3 cash secured puts or less, because the investor's probably not going to really be making that time decay that they thought, because that volatility is going up. Now, why 3? Okay, maybe some people say. The other reason why they might try to do 3 or less, and I'm just saying that in general, okay, is they're also thinking is they're trying to have some cash that if things come down, they have some capital, cash to buy some things, consider it, instead of being tied up in positions that are underwater from direction and volatility expansion. Does that make sense? So this is, if you said, man, I just realized that lately, now I understand. Well, yeah, okay, so just remember. Now, in this example, what I'm going to do is we're going to sell the 160 put, and we're going to move the price to 435 because it moved on us a little bit. Now, if we sell that by itself, this is a bullish trade, okay? But it's not as sensitive to price movement. Now, that change in the price, known as delta, that delta is not stationary. The delta number changes as it gets further and further in or out of the money, and also how much time is to expiration and so on. Notice the credit, less commission. We're going to go ahead and send that order. Now, we're going to see if that trend can't continue. But if you look at that on a weekly chart, which we mentioned yesterday, it kind of looks like, I mean, it's one of the few stocks. If you said which stocks in the market really have an RSI at a 70 level, that's funny. Outside energy, you probably say not very many. Now, there's a reason, okay? There's more buyers than sellers. That's the simple answer, and it's the answer, okay? Now, any questions with this? Now, the question is, I'm not sure we can bet upon vol decreasing in this current market. You know, you can actually go back to, so let's actually bring up the VIX just real quick. What's interesting is the volatility being higher for longer becomes harder and harder to statistically do, okay? Now, I'm not trying to nerd out here, but there's a formula called the mean reverting level. And if you play numbers, if you play kind of type in numbers with the mean reverting level formula, it is statistically harder to actually get the VIX to stay higher for longer. It's not that it can't stay higher, but higher for longer. So I get what you're saying, but actually, if you look at the math, it's no different than if companies have really good earnings, that the next earnings, even if they had good earnings, it's harder to actually still have the same percentages of growth on revenue and earnings per share. It's just harder, okay? I get what you're saying, but it really becomes mathematical that it becomes harder for the VIX to stay up at that level, and people almost become immune to it, or they just say, look, they already know, okay, the market has higher volatility. They almost get callous to it, okay? Now, the biggest actually thing is that when we go back to, let's say, the Dow Jones, one thing we saw yesterday, now remember, I'm going to kind of point out on this chart for just a moment, this, the 27th, that was actually the 28th. On those 2 days right there, that's where that Iran stuff started. And from that Iran, we've just seen the market push down. Now, when you look at the whole moving averages, there was maybe this day right here, that day right here where someone said, I'm going to take a bullish position. They might have taken some shots, maybe in that area, if they did. Now, if we look at this, if we go back to where we are here, I mean, here we are at 463. Can anyone tell me the type of candle that we're seeing so far? Now, you have to remember something. In 2002, technology got just bludgeoned. In 2007, 8, 9, the market got bludgeoned. In actually COVID, the market got bludgeoned, okay? So it's not that we don't have pullbacks. We know that, okay? The question is, after we get the pullbacks, are there investors who want to buy some things, okay? Well, some investors say, look, I got some capital that's stacking up, and I'd like to maybe buy something. Speaking of that, well, let's kind of talk about some of these names that are getting a little bit of a push. Now, if we look at, let's say, I'm going to focus a little bit on Dow stocks. We already talked about when you look at Chevron, Exxon, we get it. But I'm going to go back to just real quick stocks like Goldman Sachs. Okay. Now, what happens is when things start to go back up, people tend to remember the recent sell-off. And then when they see the stock going back up, they don't trust it because they remember the stock going down and they feel like if I get in, it's going to go down. Now, sometimes it does. But the biggest actually thing is they were usually buying things on the way down on non-signals. They don't say that part. They don't say that. But the biggest thing is they were buying when it was showing red moving averages. And they just bought anyway. Red moving averages, bought anyway. Red moving averages, bought anyway. They said they were technicians. They were buying on signals. They weren't buying on signals. They were buying on price. We're not trying to buy just on price. We're trying to buy on signals. Now, I want to focus 2 examples on financial stocks. Now, we already made mention of Morgan Stanley yesterday. And actually, you know what? I'm going to probably use this one. It's a little bit lower priced, and I'm going to go back to this. Now, if we look at Morgan Stanley for just a moment, I want to kind of say, let's say the investor says, James, I know that if I buy shares of stock, it's more capital intensive. Noted. Okay. And if someone does that, they want to have a higher sensitivity to price movement. Now, if we look at this, we saw it pop out yesterday, red candle, but still over the 160 threshold. Today, so far, that's the key word, so far bullish engulfing. Today's price action comes down near where the breakout level is. Today, we gap down, and that gap down area pretty much becomes, so far, the low for the day. So someone was buying on the gap down. Why in the world would you buy on the gap down? Because you're trying to build a position. Someone is trying, or someone, or it could be people in general, institutions, they're trying to build a position above that breakout level. Now, if we go back to the trade tab for just a second, again, we're making an assumption that everything's liquid. Let's double check. I'm going to have the Aprils open and we're going to have the Mays open. Now, here's the one thing that's bad about options, okay? If everyone and their mother and father has all their expirations in April, the 17th expiration cycle, and you don't get that movement, then your whole portfolio is pinned to that one time frame. Now, we're going to start moving some positions into May, okay? Trying to give some more time for these trends to develop. Well, if I look at the 15th May, you're now going to notice if we went to here, we're going to go look at, let's say in this case, could we, now I'm going to show in this double check, I want to look at kind of the calls versus the puts. The at the money call, 35 cents wide, but that one's really wide, okay? Now in this case, what I'm going to do is I'm going to actually buy a call at the 165 and sell the call at the 175. Now, why did you skip the 170? Wide bid-ask spread. Now, if I right-click on the 165, buy, okay, our example was we're looking at the 165, 175, okay? The debit, what we're paying, like a debit card, 480. Now, we have the right to buy the shares in the paid money account at 165, okay? That's what we buy the shares for if we did. We control that right in the paid money account in our example, and we're paying 480. So the break even, the key word is at expiration, the break even is at 169.80. So you got a $10 wide spread. And now what you see is the max profit, okay, is the spread minus what you're paying. What you're paying is the max loss, okay? Now, if someone said to us, hey, the market's just more volatile, that's when the investor might alter the strategy that they're picking. Now, we're humans. We have human nature. We just keep doing the same thing over and over again. You got to be careful of that in the stock market because if you see conditions changing, you might alter what you're picking, okay? Now, I could go into examples on that, but I think a lot of times people just do the same thing over and over again. And I think sometimes the conditions change And it's important to kind of adjust the sale or the strategy of what you're doing based upon market conditions. Now, I know you're saying, well, I like to do this. Well, sometimes that doesn't necessarily mean it might work. Notice the commission, send the order. Now, if we go back to that just real quick on the MS, this is really a breakout with a bounce setup, okay? So trade number one was Dell. Did look at Delta. Trade number one was Dell. Trade number, that was a cash secured put. Trade number two is Morgan Stanley, okay? MS. And the other one I want to go to in that financial space, if I pull up C, is this one. Now, let's say you said to me, James, I see the stock and it's coming out with earnings, let's say in about 3 weeks. Now, here's the thing. That's still 3 weeks away, okay? Now, if we take a look at this, if I said, where do you see the old support level? I think that many people would say, look, I'm kind of seeing that support level maybe right around 113 or so. And the upper side of this old channel really being right around 123. Now, what is your take upon a big bullish engulfing right into the area of support? I'm going to tell you what happens, okay? Most people, they remember what happened 2 weeks ago, okay? And this is kind of like marriage, okay? We'll have a little fun. It's over. He or she said sorry, okay? It's over. But we remember, well, it was going down, and I feel, look, what is the chart showing? Not what you think and feel. What is the chart showing? Well, when we talk about what's the chart showing, we're looking at the moving averages. Do we see actually the moving averages? Are they green? Has it crossed over? Yes, yes. Did we actually get a little diagonal breakout to the upside? Well, let's draw the line. Can we see that? It's pretty much when we had the moving averages cross. And what type of, are we getting any like bullish setup signals? Well, that would be like hitting a brand new short-term high. It could be a hold dot. And the answer is we're seeing those as well. Candlestick types, what do we got? Bullish engulfing. Now, in this case, let's say the investor says, look, I want to buy the shares and I want to try to do a swing trade. Now, I'm going to tell you what I've learned in 30 years of doing this. When the least amount of people are watching, that is when there is a peak state of opportunity. Let me repeat what I just said. When the least amount of people are watching or in a peak state of fear, that is when there tends to be a peak state of opportunity. Investing is counter to your emotions. In the middle of COVID, when everything was horrible, for some investors, that was the peak state of opportunity. Now, you could say, hey, look, legit, I felt fearful. But that's when there tends to be the peak state of opportunity. Now, does that mean that everyone should get in? No. But the thing is, they might start to try to build investments when they see the signals that they're looking for. Now, what I'm going to do is going to go buy custom with OCO bracket. Now, in this case, we're going to put a little target. What's the target? Well, I'm going to put about 123-ish. That 123 limit dated GTC, and then I'm going to set that stop underneath the moving average. Now, that moving average, the 20 period, you're now going to see is I'm going to take that 20 period moving average, which is at 108.93, 108.93 less 2%, and that's going to be at 106.75. I'm going to type that in, 106.75. Now, being disciplined, right? When we go back and say, well, how much capital could you invest? Well, if we're trying to put in no more than, let's say, 10% of the portfolio, it's going to be about $4,000. Now, you got to remember something is this portfolio started out at a certain amount, went up. It was up probably about 12% year to date at the high. It came back down to pretty much where it started. And then, now you got to remember, it drew down, okay? So now the thing is we're trying to, as if the market tries to go back up, we're trying to rebuild it back to where it went up, well, where it came down from. Now, we're going to go dated GTC, stop, target, and going to see if it actually gets a move. Now, the goal on this is not protected. This is shares of a stock with a target and a stop. The stop is saying if it goes down to that price or less, sell the stock. The con about doing that, if you did this on, let's say, I don't know, 10 positions, the risk of doing stops on all positions is if you have one bad day or a bad trend in general, you could be stopped out of maybe everything, perhaps, and you don't have any positions. Is that a great idea to have stops on everything? Some investors might think not, because they're trying to have an allocation to the market and ride longer term trends. Who uses stops? Traders. Okay. Now, the biggest actually thing, let's go back to other questions. Any other questions? So trade number one was actually Dell, cash secured put. Trade number two was Morgan Stanley, a long call vertical. Trade number three was actually Citigroup, a little swing back trade trying to get inside the old channel. The other ones I kind of want to make mention of that we kind of pointed out yesterday, and I'm not going to do anything on that, but because we hit it twice in our examples, AMAT is another one that kind of had a little reversal. You had a red candle yesterday after making a short-term high, and that is showing another close above the high of the low day. And remember, the point we've made over and over again is when the price is above the shorter-term moving average, could be potential pleasure. Price below the moving average could be pain. Now, if we ask as bullish investors, where do you want to see the price? It's not even a question. You want to see the price above the short-term moving average. You get the momentum and you get the trend working in your favor. You got it to your back at that moment in time. Now, the one I want to bring up, if you look at, let's say, ADI, sometimes people like to kind of look for, let's say, examples where they've pushed down and they might just be starting to reverse. Well, I'm going to do 2 trades in 5 minutes on stocks that are trying to reverse after some recent consolidation. ADI's had some actually push down, and there's some gaps on this chart. And what happens is when you have these gaps, you're thinking, well, these are areas of resistance. The key is we want to say language like these are potential levels of resistance. Now, if someone says, look, I don't mind to do a position, but I want to maybe do, let's say, something that's probability based. So 2 quick examples. One, we're going to look to do, let's double check. Now, the question is, if I looked at the April expirations, tight bid-ask spreads, that's a dollar wide. I can't do that. I mean, you could, but it's just not great pricing. That right there, that's why, that's probably the narrowest. And if you look at the open interest, there's not even a ton of open interest. So on this one, we're going to pass on that options because they're just really wide. And we're going to look and see if we can't play a little reversal. Are all examples stocks options? No. This is why you kind of change the strategy when that liquidity is not showing. Now, if we take a look at this, I'm going to go back to say where might be a level of resistance. I'm going to try to even target maybe right inside this red candle, maybe 336. Okay. Now, I'm just going to put a target there initially. That's not saying that's maybe all. We're going to kind of evaluate, watch it over day, and see if that trend can't continue to the upside. If we look on this bottom here, okay, when we look at those kind of moving averages, could we set a stop underneath today's low or open price and have a tighter stop? Well, that's what we're going to try to show. 311.30, less 2%, 305.07. So if the trade does not work, it's really going to have a stop right underneath today's low. So if this bound spot does not hold, the stop is right underneath. Capital size, if we went back, how much? At the most, 4,000, which would be 12 shares. Going to go confirm and send. Remember how the stop works. If we go to that price or less, sell it. Could it be filled at a lower price? Yes. Okay, that's the risk of that. Now, what I'm now going to do is I'm going to go back to one other example that we're going to follow through on from yesterday, which is GLW. Now, GLW was kind of right here. And we talked about kind of some stocks that were kind of sitting in a very narrow band. Now, it doesn't mean that it can't break out of that band, but the investor is probably using buy stops, buy stop limits, and or alerts. And if all of a sudden the price starts going above the 136, alarm bells, all of a sudden, if someone was bearish, they might cover their short position. If an investor is bullish, they might be saying, well, I'm looking to get in if the price can do this. Well, doink, lo and behold, alarms go off this morning. And all of a sudden, if someone was bearish, they're saying, wow, geez, this is short-term high. That doesn't necessarily mean that's not a bearish trend, okay? That's a short-term high. You get a short-term high, that could be reversing the downtrend. You get a short-term high, you might make a short-term higher low. That resistance could turn into potential support. You see how it changes, right? Now, in this example, we're going to go back to, we're going to right-click on the chart, buy custom with OCL bracket. Now, what we're going to do in this case is we're going to set the stop right underneath and give us a little bit more room here so we can see that bottom. And what I'm going to do is let me kind of start. There we go. Just have price only. So if we looked at kind of said, well, where was today's open price? 131. Good grief, that's pretty low. Let's say someone said, hey, 136. I'm going to set the stop underneath there. Now, why didn't you get in the trade this morning? Because we do the trades in class and we can go over them, okay? Now, if we take, let's say, 136, which is where the breakout level was, less 2%, you're now going to see it's at 133.28. So I'm going to type that in, 133.28. Dated GTC, dated GTC, okay? Now, go back to this. Now, notice what we're not doing. Yeah, well, I remember when the market was going down. I remember the market. Look, that happened. Yes, we know that. Markets go up and down. We know that, okay? Now, when it goes down, that might cause some stocks to start going up. That's what we're trading. So notice we're not falling into the pit of emotion, okay? And trading based upon feeling. We're trading based upon technicals and what we're seeing. And we're also being willing to invest capital and risk capital. Now, when we actually go back to the target here, we go back to that target and say, where might it try to go up to? We don't know if it's going to. I'm going to put a marker at 157. Now, that would be our final trade. So we did the example given of Dell. We did the example of, that was, by the way, Dell was, we did Dell, we did Morgan Stanley, we did C. We also looked at Corning as well, and we recapped AMAT. So there's a little follow through from yesterday, but there were kind of some setups that were setting up. Some of these, this is a stock position as well. So also remember, if someone is doing stock, they're really saying, look, I think I might be right on the direction, and I want that dollar for dollar price movement, okay? So I'm out of my time here today. If you have not subscribed to the Trader Talks channel, it's simple, okay? Go right to this page. If you have not subscribed already, just click on the middle of the page and you can subscribe. That way you can see our content that we post on YouTube. If you actually say, hey, is there a playlist for this class? Yes. Bookmark it. And also don't forget to follow Barbara and myself on X. We do post content there and also some humorous things as well. Now, remember, we have Camera Made coming up next. I want to thank you so much for your comments and your participation. And also remember that when we talk about markets, we know the markets can go down, yes. But when you go back and look at when markets go down, there can be some opportunities that they could bounce back up. Keep that in mind as we've talked about that over the last couple of days. Remember, with what we discussed, it was done for example, illustrative purposes only. This class has been the Investor Master Series. We meet on a weekly basis, live and recorded. So keep joining us and watching those sessions. Barbara Armstrong will be teaching this afternoon. Join her as well. Thanks so much. Take care. Bye-bye.